Welcome back, Crypto Creeps. It's Crypto Currently podcast and show. And a couple of things here. Everybody's looking at Bitcoin being kind of stuck in the mud, right? Just kind of bouncing around 15,000, which is strange because there's like 60 billion new dollars in the cryptocurrency markets altogether. There's all this new liquidity and everybody's looking at, look, I brought a little prop. Everybody's looking at Bitcoin going, come on, do an investy thingy. But it's just kind of sitting there. Well, never fear, all right? By the end of February is what I'm saying. Probably more like 2 weeks from now, but by the end of February, in golf, these are called the yips, all right? People kind of got freaked out by a couple of things, and mainly the volatility and people's understanding of Bitcoin being limited. People are just kind of in a holding pattern right now, especially with Donald Trump's new tax legislation that just went through. The part that deals with cryptocurrencies specifically, that's kind of looking nightmarish, and been doing a lot of research on that, and I'm still not clear as to what the actual rules are. But a couple of things I'm really happy about. I want to show this to you, and just not so much to inform people, well, to inform you, but to kind of share my joy. As you may have gathered in my previous shows, I used to be a commodity trader. I used to be licensed, and I would trade on behalf of my clients. I wasn't like a day trader, some guy in my basement trading my own accounts. I put on a suit and went to work every day and took my clients and guided them through futures and options contract purchases and sales. So commodity traders are just a different breed. We're not stockbrokers. We're not financial planners. We're the high risk guys. All right, and because of that risk, by law, there's a lot more required of us as traders when it comes to disclosure. Right. That's why I kind of start off all of these shows with kind of a funny quip as far as disclosure. Like, look, here's the big disclosure. It's a high risk market. You're 85% or better of the time you're going to lose. All right, so that's the deal, right? If you're risk adverse, all right, if you can't handle the idea of any part of your money being lost, don't get involved in high risk things, right? Don't do it. When I was a trader, it was always lawyers and engineers for some reason. Lawyers always wanted to argue about everything, and engineers just thought too pragmatically. You know what I mean? Everything was too structured for them, and we need that from them. We need that. People who build bridges need to be very very methodical in their approach to everything in their life, I think. But anyways, I started as a trader in 1998. Okay, I think I was 25. I was good looking, still had all my hair, the whole shebang. And 1998 there was a lot of money being made in the stock market, right? There were stocks that were trading at 400 times earnings, and people were just buying the hell out of them. Made no sense whatsoever, right? To buy something, it's like, okay, if you go to 7-Eleven, you go to buy a super big gulp, it's $2, right? And all of a sudden, everybody decides that they want big gulps. So you go to 7-Eleven and you try to buy a big gulp, and it's $800. You'd be a fool to buy it, right? Well, that's what was going on in the stock market, right? It's like, dude, it's not worth that much money. You're buying something at 400 times what it's worth. So I guess my math was a little off on the pig cult analogy there. But anyways, I digress. Uh, those stockbrokers, they didn't have the legal requirements to disclose to their clients the way we did in the futures market. Like, we would have to tell people, and we would have to record every single disclosure talk before every single trade. Every day that I went to work, I put on trades or took people out of trades, I would have to record them in a conversation, give me their name and their social and date of birth and place they lived. Like, it was a hard process, because it's like, dude, I got trades to put on. I can't be sitting here for, I got to take 5 minutes and tell you, like, hey, dude, you understand this is a risk? You know what I mean? Like, it was stupid. Meanwhile, stockbrokers didn't have any of that. Like, they could just tell people, like, oh, this is an investment, and we and I always thought that those guys were condescending and smug, because, God, they had it easy. And it was hard to get clients as a futures trader, futures and options. It was hard to get new clients because there was so much money being made in the stock market, man. And the big payoff in all of that, after years of that, right? That didn't end in 1998. It kept going. And after all of that, finally, the tech bubble burst, right? Alan Greenspan, he was the Secretary of the Treasury. He came out and rebuked the whole nation, and he said, "You people are acting with irrational exuberance." And within like a week of that, or something, like a week before or the week after, what's his name? The big investor, the richest investor in the world. He came out. God damn it! What's that guy's name? Anyways, he came out and he says, "Yeah, I don't invest in any of this tech stuff." And they asked him why. He says, "I don't understand it." And then the tech bubble burst, and oh boy, that's really bothering me. What is that guy's name? Warren Buffett. I'm sorry, Warren Buffett. He came out and he said that. Anyways, the tech bubble burst, and companies like Dean Witter, Morgan Stanley, and Merril Lynch, and I'm about to get to Merril Lynch here in just a second, they had to let go of a lot of their brokers. Like, a lot of people got fired because the brokerage houses lost so much money. They were just hemorrhaging money. And there were a lot of lawsuits, lots of lawsuits. In fact, in 1 year, there was over $600 million paid out in lawsuits in just Orange County alone, right? In one of those years, just to give you an idea, like, people lost their jobs. It was devastating, and it was devastating to the actual clients, right? Whereas my clients, if I tell you, like, hey, look, you're probably going to lose money on it. If you give me this money to put on this trade, you're probably never going to see it again. But if I'm right, whatever. That's why I do the disclaimers I do. So going into let's put some glass, when you put your binoculars on and look for the animal that you're hunting, that's called putting glass on it. So let's put glass on Merrill Lynch. Merrill Lynch bans clients from Bitcoin Fund. Yeah, suck it, Merrill Lynch. Look at this. The Wall Street Journal, upon reviewing an internal memo by Merrill Lynch, reports that the brokerage arm has specifically highlighted Grayscale's Bitcoin investment trust, an open-ended fund directly invested in the world's first cryptocurrency. It goes on to say, the discussion to close Bitcoin to new purchases is driven by concerns pertaining to suitability and eligibility standards of this product. Yeah, Merrill Lynch, you know what? I bet your clients back in the late 90s and early 2000s would have really appreciated you being a little bit more conservative in your approach, or at least being honest with your clients before you're dumping them in slicedbread.com. Look at this. This is the part I want to get to. So traditional Wall Street banks and brokerages have been hesitant when it comes to cryptocurrencies, even as major financial institutions like the CME Group and the Chicago Board of Options Exchange began trading Bitcoin futures contracts in December. prior to the launch of Bitcoin futures markets, like with the likes of Citigroup, Bank of America, and others, blocked clients from investments. Now, let me just explain that. What they're saying is if you're a client of Merrill Lynch or Citigroup or Bank of America, Merrill Lynch and Bank of America are in bed together, but if you're one of their clients, you cannot tell your broker, I want you to go buy this Bitcoin for me, right? And you know why? It's like I said in one of my first shows, the meaning of words, people. Look at this. Citigroup, Bank of America, and others blocked clients from investments. Investments. Oh, that's a really funny word there. Why would you block somebody from investing? I'll tell you exactly why. Because when you put your money on any sort of currency trade, be it cryptocurrencies or buying the yen or the Swiss franc or the Japanese yen, or if you want to get weird and go trade the rupee, that's a speculation, right? You're just speculating. You're trying to make a whole bunch of money, trying to take a little bit of money, make it a whole bunch of money. That's a speculation. It's not an investment. And these people, they don't have the stones that it takes to sit down with their client and say, look, Bitcoin or whatever, I'm all for it. Let's do this. But you have to understand that this is a speculation. You can't put investment dollars into this. If you want to invest, go buy real estate or go buy General Electric stock or whatever. But this right here, there's only two things you need to trade currencies, and that's stones and money. So because these people can't articulate this to their clients, like, look, we might as well be playing the ponies here, right? And you should have a certain portion of your investment portfolio that is specifically set aside for high risk ventures. Why? Because it adds fun to the experience. It adds enjoyment and excitement. It gets your blood pumping. It reminds you, like if you get into some of these cryptocurrencies, you're going to be reminded that these companies behind the tokens, they're just people. They're just people, just like you, right? They have strengths and they have weaknesses, right? Now, hopefully their strengths are, what's going to pay you, and that hopefully their weaknesses don't rob you. But you learn that stuff as you trade. And this cracks me up. This Merrill Lynch banning their clients from investments. It's like, dude, you know what? Just like Sean and Gus used to say, suck it, Merrill Lynch. Ugh. You don't have. And look at this. Last thing, and I'm gonna let you go because I say I'm coming up on 15 minutes here. So traditional, I'm sorry, I read that one. In the days following the launch, that's the launch of the futures contracts. You remember that in December. Chicago Board of Options Exchange chief executive dismissed complaints from the Futures Industry Association, which is their kind of like a watchdog group, an influential Wall Street lobby group comprising of the likes of J.P. Morgan Chase and Goldman Sachs, delivered to the U.S. Commodity Futures Trading Commission, that's the CFTC, in a letter. And the letter was labeled as a cheap shot by the CBOE's chair and CEO, Edward Tilling, adding it uncalled for. So these people, like, they're such little crybabies, right? They're so afraid of being accountable to their own clients, right? That in an effort to discourage the futures trading on Bitcoin on the open market, they wrote a letter complaining. I don't want the futures on the cryptocurrency because I don't understand it, and furthermore, I don't want to have to tell my brokers, my licensed Series 7 brokers, I don't want to train them to be able to describe what risk is to our clients. We want our clients to think that we're the smartest people in the world. It cracks me up. So anyways, Bitcoin's fine. All right, it'll get running here. Just let the Christmas hangover wear off. It's day 5 of January. Bitcoin's going to be just fine. And last thing, Merrill Lynch sucks. Those people, those people in that world, the stockbroker world. You know what? If you want to buy stocks, my advice to you: go buy every book that Warren Buffett ever wrote. Read those, do exactly as they say, and you'll be fine. All right, that's it. I'm out.